Hello, everybody. Today we are trading again. Now let's have a look what we've got yesterday. That's from yesterday. So we keep grinding lower. Don't close that one there because still have chances to get rid of that. Yeah, still have chances to go up. And if we go up, we have to be prepared for that because our main aim not to lose potentially. I'll explain in a second what could happen there. Yeah, so that. So I've got the more sophisticated drawing tools. So that's I'm going to be drawing there. Right. So what we've got is go on, slowly. Right. There. So let's say we close that one there. Oh, no, there's one pencil. That one there. We close that one there. And what happens if the thing goes up? Right? It's very possible. It's very possible the thing can go up and up and up. And get to 1,000, despite the market cap is quite heavy. Still, everything is possible. We have to assume that everything is possible. So that's that. However, if it's gonna chop, and as you can see, well, it's chopping since yesterday, and it could go for another day, 2 or 3, because the price has dropped. As you can see here, we never know. So basically, what happens here is, at the moment, I turned off protective stop loss because I suspect that the price is supposed to get to the equilibrium, which is my estimation somewhere here, like that, right? Or even if we look at the longer time frame like that, right? So the equilibrium here is going to be something like that, right? So, potentially, you see this is the anomaly here, and that means is that the thing would want to get to the average, right? And the average is like that area there. So if we assume that this average goes up, the thing potentially might come down there. So the idea is to find an anomaly, and when you see the anomaly, play with that, but also always keep in mind that this is crypto market and everything could just go any way it wants, and the main idea is to be prepared and have a robot helping us to avoid losses. So that's the whole idea. So for now, again, as I've stated before, right? So the main numbers are here. It's the size. So at the moment, we've got twice the size of the winning position compared to the losing position. And what that means is, so further price goes in this direction there, it's gonna increase UPL twice faster, right? For now, when it's going to be safe, I don't know. I would probably add somewhere here, see how it goes, see how the price action and so on and so forth. But this is there is not zero probability that it just can just consolidate here, and as people are saying, it's a bull flag or whatever, and goes up. Uh, the reason it grows, I reckon, because of the tensions in Iran, and the elites are trying to run away in crypto and hide their assets. And XMR is the best known tool for hiding assets, and hence we saw this like spike there, right? Because uh, when the war began with Russia, they were not that afraid to hide their income because, like, most businesses were legal in Russia, and they were connected to the West, and that's why Bitcoin rose a lot because their elites run away from the war through Bitcoin. Right here, it's a bit different because Iran was under sanctions all the way, and the elites didn't want to be exposed in Bitcoin, so they obviously run away there. So now, if war is going to be on pause, or even some solution would be found, then I think the price will go to equilibrium because Monero itself is a bit pain in the back. Not many exchanges are accepting it. It's quite hard to like change it. There is a big commission if you do P2P and so on and so forth. So it's sort of dirty money. So that's the thought behind it. Okay. Okay. So let's remove that. To remove drawings there. Other trading ideas here. So we've got that one there. Remove that one. There, minus loading. XYE, whatever, 16%. Yeah, and Dash is alright. That's how we've got that one there and that one there. What was yesterday? Right. So, okay, this file is still on. Well, clearly we missed it. So you see here is the equilibrium price, and like if we were somewhere here, let's say just growing, then we could do something about it. What we've got here is like 5%. Yeah, not a lot, not a lot, not worth a lot of attention. That one is interesting. Yeah, let's have a look what happens here. So yeah, it found an equilibrium itself, but again, let's have a look what we've got about this dash coin. About market cap, 500 million, right? Did it change? Or we've got, oh, look, it was 500 million. When was that? Do we have a date here? Right. Yeah, whatever. That was yesterday, the day before yesterday, whatever, I don't remember. Anyway, 1.2 billion here. Volume rolls from 180 million to 875. But I don't see any. I don't see any signs of trend changing. Because, like, in order to show, and again, that one also would find its equilibrium here one day. Let's have a look here. There, you see. So it's not the first time, and here you see similar thing, right? So what we've got here is it's quite a good percentage net, and it was like 4 days. In 4 days, it jumped to 60%. what we've got here. And yeah, and also you see there's consolidation phases, right? So we've got one consolidating the rules, then second leg consolidating, dropping a bit down, and then 1, 2, 3, like 4 hours. What about that? Let's have a look. So, what was it? Oh, there. Was it? Yeah, was it there? Right. So we're consolidating for how many hours? For 1 day, 9 hours, and here as well. And here you see it was all over the place. The volatility is what we like, 60% for 12 hours. That's where we make most of money, right? So going back here, look, it can make another leg higher for wherever. Here what we've got is 11%. That's quite good volatility, but like don't know, like 50-50. However, I entered this trade because one interested in not in just uh, waiting until it's a perfect setup, right? Because it never will be. But I'm here to display that Robert is working, and it doesn't matter what setup is. You enter the trade, and the Robert will take care about protecting your capital, right? So let's give it a go and see how it goes. Regarding yesterday's performance, we've closed in plus. So what was it here? Was it DOLO or whatever? Dollar. Yeah. So it was a bit of it was a bit pain in the back. This dollar thing. However, it, we've been able to just jump out with again. Oh, that one there. Let's have a look what we've got there. Yeah, we were able to jump out of the trade with minimal losses because the uh, direction was all over the place. I mean, price direction was all over the place, and we couldn't do anything. Right, we see. So, we entered right here, and because it was jumping up and down many times, the hedge got in. Then the problem with the hedge is that we draw it down there. So, right. So, what we've got with the hedge was so let's say we shorted, like we open a short position here. Doesn't look nice, does it? Right. So let's say here is the short position, and it's like 10 units. So price goes against us, and we put a so-called lock on it. Let's make it black. So that's long position, and it's 10 units. And price goes up, and we got another 10 units here. Now, so now we've got long 20, and we've got long 20, 20, and it reverses here, and it wasn't enough room in order to make it even like 10 to close with protective stop loss. Then it goes down there, falls down, it makes like, no, it's 20, right? And this delta grows. So first it was like -5%, then because we double that digit there, it becomes -10%, and we double there, and so on. So long story short, where would we, right? So here our initial position, when it goes up at there, we make it two double initial position. And if it goes up, because this number is bigger than this one, that means as soon as we cross the delta and make a bit of profit, we close it here somewhere and we exit the trade. Now, the problems are when you open the position, you go up, you open the hedge, right, to us, then it reverses, doesn't give you a chance to pass losing leg uh, or or close a closed position with profit, and it reverses back, and then you double it again, so it becomes here was S, now it becomes 4S. So we've got 2S here and 4S here, and it goes back again, and you have to double it, so it AS, right? So all the time we're thinking about if it goes there or there, we win and close it, like don't have a risk, and we lose only delta. But because the position grows itself all the time, the delta minus is growing. But having said that, we always have a chance to win, right? So let me show you what I mean here. So open it. Here is 50-50. Right? If it goes down, we close it, we win. Just clear, nice and clear. Right? If it goes up here, 1%, let's say, and we have a hedge. From this point here, if it goes down there, we lose, and if it goes up here, we win. And again, here is 50-50. Right? Then it goes down there, and again, we win 50-50. So the idea is we execute trades and we just double for the same trade with double amount, and we execute the chances. So if you've got first time 50-50, which is all five, the second time is all five times all five, the third time is all five times all five times all five. And that's the probability, right? Uh, it's not exact that because it's a multi-parameter function, but the whole idea is you've got several tries in order to quit, right? If you've got just 50-50, so for example here, you just go up, and if it's stop loss here, you've lost it. You've lost it. That's it. No chances. But if you see the price is going up, or you strongly believe the price is gonna go down, yeah, so you hedge it here with like same amount, right? And it doesn't matter if it goes there, there, and there. You can always like close this, lose only this delta, then reopen your short here, and because the price moved like 50% up, the chances it's gonna get back to equilibrium or higher. So I hope that makes sense. Anyway, let's have a look. What is trying to tell us? What was it? Price alert for Dash. What we've got? Dash here. Yeah. So what? Oh, I take profit is on. Look, that's super cool, isn't it? And 2.7. Yeah, is it 2x? And that means 1%. 1%, and here's our take profit. That's super cool. Manually, we can create the what is his name? Stop loss, protective stop loss. So what happens now is if a price reverses, we are getting all 4% as stop loss, but that's plus. If price keeps grinding up, then we just close with existing take profit. Simple as that. Right, but Me personally, I don't like this setup because it's random. And getting back to our picture here, like ideal scenario, if we've got, for example, a huge fall, or I'll draw it in red, right? So we've got huge fall, and then the price was like going that way, right? So the robots, some AI agents, and so on and so forth, they would see that as a signal, and they will be thinking that the anomaly will get back to equilibrium, and the probability they are going to buy somewhere here is quite high, right? So uh, so when I see the anomaly, based on that, the probability, getting back to our subject, so we've got long here and it goes up. And for example, if our target is 2%, 3%, then the probability it goes up and doesn't chop around is much higher, and this is what we are looking for, right? So we'd like to one clean move in order not to employ our hedging strategy multiple times, right? If I'm talking about here, uh, I don't like it because let's say I open short here and it's got 2% the hedging distance, then it's going to hedge it here, then add to long here, then hedge it here again, and then and because with every move we doubling it, that means we put more and more capital at risk, and we don't want to put a lot of capital at risk really. What we want is just enter as less risky trade as possible, and for that we have to have a clear movement. It doesn't matter which way it goes, as long as hedge is working, right? So let me draw it. So oh look, yeah. So Robert is telling us that the position is closed, and it's doing this because we have to know that maybe we'd like to reopen it. Do you know what I mean? So we have a look there and say, oh, well, okay, maybe we'd like to short it. Would we? Why not? It's going to go. But well, I don't know. I don't know. It's just like 50-50 game, and I don't like it. As a matter of, again, a demo and as a example of what we shouldn't do is like trading out of boredom, right? This is really bad thing, right? So we have to wait until our system is going to show us something like what, something like that, and then we see that, and we see the anomaly, and we understand that this is a good anomaly. We like it. This is a good entry point, and so on and so forth, and then only then we enter it. Otherwise, it's going to be just uh, waste, right? However, yeah, and again, to me, this is just complete randomness. I've got no idea where it goes. It just, and here it was just luck, let's say. And the main problem is with people. I'm going to be talking about this later when we get back to neural networks and stuff that we are getting fooled by randomness because our brains are evolved in order to find patterns, and we are thinking we understand the life, but in reality we see something in randomness which is not actually existing in reality. Right, okay, so the whole system is designed in order to catch the movement. So for example, get back to drawing here, we get back to this what is that? We get back to this coin later. See how it goes. So for example, we got there, right, or put long, and it goes straight up. No, wrong one. Sorry. So let's say it's falling, right, and we see consolidation, and we think it's a bear flag or whatever, and we put short here, right? So, and it goes back, right? Because it was the anomaly, and because it was like fall of like 40% or so, so that means in 2% we put our uh, long, which equals 2s, two shorts, and in like if we've got here 2% delta, right? So we have to move about 3.5% in order to close this position and have a little profit, right? Uh, on the other hand, if the same thing is happening with pump, so it was like something like that, then like Monero goes up, Iranian away into the anonymous coins, and you see the anomaly is up, and we put our short here, and it goes up again, opens the hedge. But anyway, because this is the anomaly, it returns back, and our moving average is over here. The probability, we're not. Oh, hang on. How to show you? How to show you like that? Yeah, there. The probability it's gonna go down higher. Uh, the probability of clear movement in one direction is higher because this is the anomaly and volatility is high. And what means volatility? And that's precisely why I've got this measurement here. The means is if volatility is high, it's going to be enough of that volatility to close our hedged position in one go. Because if it's chopping around like that, right? So it's going to open, close, or open our uh, inverse hedges many times, and this is what we don't want. So we want just a clean movement. Sometimes there is another situation where we've got, like, let's say it's falling and we happen to put short here, and then it's chopping, then we don't really care because like it could do anything we like. It likes until it gets to our target and we close it on the no, it's not a stop loss, it's take profit. So that's that. Let's have a look. What's going on? Oh, Riva is just flowing up right here. And again, I've closed it, but I see the impulse is under the averages. You can see it goes like that. So it just got to the price equilibrium, price discovered, and now it could go like that for ages. And I don't want to waste my life just looking at it and hoping it's gonna one way or another. What we've got, our dash here. Yeah, it returns, but again, I don't like it. I don't like it. Here, you see, you go back, but because this one is a heavy coin, so it could take time. It could really take time. So I don't really care. It could take even days. I think my target is somewhere here, so that's gonna happen on 19th. Today is like 3 days or so. So again, uh, those ones are slow ones. Right. Okay. Yeah. So nothing is here for now. We'll borrow that one. Yeah. Application is sending the alerts in real time when some. Is it button to clear everything here now? I have to do it manually with the razor. Right. Okay. What was I talking about? Yeah, that one looks alright. but again, I can't say this is impulse exhaustion, right? So go down, back, and what about longer time frame? Well, yeah, I don't know. Looks randomish to me. Okay. Well, why is it not working? Okay. Reverse. Or that one. Whale and pump. Here's the T. Let's have a look at that one there. Get rid of those. Oh, that's the weekly one. Yeah, looks a bit of support. Right, so it was grinding low and then what we've got here is 29%. You know, could go as up as down, so I don't know. Right. So what I was going to say today is about neural networks, and that's the topic I love. So we'll be drawing today a bit how it's all working. Okay, so how our neural networks work will be related to previous topic, but a bit more with the education and skills development. So we've got neurons, input neurons, right? We've got neurons in the other layers, like that. Right. And we've got neurons which are controlling actions, right? So this one is controlling legs, this one is controlling tongue, fingers. What else we've got? Fingers, don't know. Sensors, right? And they are all interconnected. They're all interconnected. Right. So it looks like it's really primitive schema, but you get the idea. In reality, the amount of neurons in our heads is astonishing, and on the top, also they're interconnected with between themselves, with one to be connected, and so on. And now here we've got input of information. I'm not going to talk about the stomach and back and so on and so forth. I'm going to talk about, like today, what we're using, which is quite easy to understand. So let's say we've got an eye here. I hope it doesn't look like a T. Right? And some other like eyes. What else we've got? Ears. Ear. Right. And yeah. So and they are connected to our neural network ourselves, and basically what happens there is important thing is sometimes our like when we consume information, it doesn't end with an action. It just like get remains in the brain and kept there as memory, and we sort of make suggestions, fantasies, and so on and so forth. So let's say that's going to be that area there, that like thinking area, when we just consume information and just process it. Uh, so, so, so what happens? Uh, what happens then? Well, some information is getting in our way. So let's say, right, that one there, and that one, right. Make it smaller. Right. So we've got my chart here, and we've got plenty of those placed in front of our face, and we consume that information, right? And then we think about it, try to find patterns, try to find mm, try to find some, try to derive different patterns out of the information in order to get a higher PNL and avoid lower PNL, right? Yeah, so that's our main goal, right? Once we get loss, the neurons are getting excited and we are getting negative emotion, right? I'm going to be talking about emotions later. It's a complicated topic in itself, but like the primitive thing is this, right? So let's say we have those patterns, thousand times, uh, and every time those patterns are going through our neural network, we're thinking about them, we're taking actions by uh, pressing buy or sell buttons, and in the end, we're getting either reward or punishment. And because this iteration is happening many times, 1,000 times, 2,000 times, and so on and so forth, then taking, we are creating particular skills in our heads where our neurons they are becoming sort of rigid to particular patterns, and we do not think about particular actions, we just execute them. We know that statistically speaking, the probability of the reward is much higher than the probability of the punishment. So, what's important here, what's important to understand, and this is how every skill is made, not only trading, but the trading is interesting in particular. What important here is that, right, let me move it here, right, okay. Uh, what important here is, so we are having a sort of feedback loop, right? So we've got information which is getting to our brain, which is leading to an action or actions, a lot of actions, which is leading to the result. This result is getting to our brain, and brain is looking for the information again. So this is called feedback loop, right? And this feedback loop is generated by the result, either punishment or reward. So what's important here? The important point here is because markets are random, the information here could be could be very random, and because it's random, the strategy we are developing could lead to losses because market conditions change, and our strategy doesn't work anymore. But because we've created plenty of neural connections in our head, which are leading to automatic actions, those actions are leading us to losses because we try to execute the same strategy for new market conditions. Hence, because market is different and all strategy is not working, losses are inevitable. So that's done. Now, what's the remedy? Well, remedy is to have a precise look and really fine-tune adjustment to our reward function. Because if several trades in a row do not work as they used to work before, we have to admit the strategy doesn't work. So it's really a trading skill to try to understand straight away the strategy is bad, it's not working, and we have to do something about it. Well, otherwise, you just destroy your capital. Right. So, in artificial neural networks, it works that you've got your information, you've got your model. Sorry, that's not. And then you've got your model, right? You've got your information, uh, information data set, and you iterated this dataset through your model over and over and over. And then what you do is you got your model, you got your information from the real world, you push it through, and then you see the results. And a good model works if the results are similar to the results you were getting through training process, right? So if information from the real world is not processed by the model and you are getting random results, that means your model is not working. Either it was overfitted or some other problems, or maybe a problem is with the dataset and so on and so forth. And that all applies to our brain as well. So, how to deal with it? That's interesting image. How many synapses in the brain? That's a lot, a lot. Yeah, but that's another topic for the discussion. Right. So, let's go there. Let's go there. How to avoid it. How to avoid it. How to avoid those problems. What about avoid? Yeah, grows a bit in it. That's all. How long? How much? 13%. Could we? Could already be. Yeah, but I'm afraid. So I miss it, and it falls down again. It always easier to short than to go long. Depends on the coin, of course, but on those little coins, because because nothing can't cost a lot for a long time, and I can see that there's like mem coins are just nothing. So if nothing costs a bit, the probability that it will go back to zero is higher than when it goes to zero and becomes costing. So, do you know what I mean? So, but again, this is my psychological bias, and probably in it. Anyway, so back to neural networks. To neural networks. So, important point is our data set, right? So we've got our model and we've got our training. So we've got our data set, and in our case, data set is charts with combination of economical info, economy, with combination of, I don't know, other charts like RSI, let's say, with combination of, and so on and so forth. Well, right. And when we supply that and we get the result, the main idea is we have to understand which features our model is extracting in order to get the result, because this looks like chaos, but inside of the model itself decides that today charts are important, or 50%, economy is important for 10%, market cap, let's say, important for another 30%, and model is spreading this importance in itself, has a complicated mathematical function inside and gives us the result. Now, why I decided to have my own model, own robots, precisely because I want to control what's inside. When it's a black box, somebody's robot, then you don't really know what happens inside, and you have to rely on somebody's prodigy, right? That results are going to be good. It never worked for me, so that's why I have to take this in my hands now. And what I got was that those things are important, of course, those ones, but the most important ones are the other ones. And I'll explain which ones. So basically, here is the graphic, for example, and here is open position. Position is open here, and importance of the model. Importance of the model could be described as size of the of size, uh, position size, right? Margin left, and risk associated. What I mean by that? And I fully concentrate on that most of the times. The graph itself gives me, I don't know, 20% of success, 30, 15, whatever. But the most important part is this. Why this is important? Simple explanation. Let's say, let me show you an example. Let's say we decide being here, and let's say we decide here is 22%, right? And we've got 10x there. Let's say we put 100% of our deposit here long. We were thinking that price was falling and falling and falling, making a basement, and it has to shoot up because, I don't know, we just think so. We find 500 reasons why it's so. So it's making a base, right? It starts to go up, and we put long here, but we don't only put long here. We put 100% of the deposit, and we keep 10x. So what happens? Price goes down there. If we don't have a stop loss, we've lost If we have a stop loss, we've lost like 10%, let's say, not 30% of the deposit. If it goes down there and we don't have stop loss here, and actually on the graph is here, it's going to be the liquidation in, let's say, 4%. It's going to be the liquidation and deposit's gone. That's it. We don't have money. Go and work in McDonald's to make more money in order to win a game. Now, so if we've got that, so that leads to the conclusion that important parameters in order to get successful trading, and successful trading is calculating probability, P. That means probability will consist of leverage, position amount, and leverage, position amount, and deposit left or margin. Oh, let's call it margin. Right, margin. Right. For one single position, and I'll show you what I mean by that is, like, let's have a look at here. So let's say I've got a single position, and I have single position. I can show it here, right? So what we've got is 88 long, 181, and 2x leverage, right? So the open here. Oh, look, it gets back. And I've got 100 left in my deposit. So the function here is amount of capital at risk. So let's say 188. Let's get in there. 181 minus 88. That's going to be 100. Yeah, that's going to be that. So we are risking with $100 now, the hedge there, and $100. If it goes up, the price goes up. We have margin, which is 100, right? And we add this 100 here, and it's going to be 181, let's say. And then we are risking just like zero margin minus delta between those positions, right? If we didn't have a hedge, we needed 180 in order to get to the zero risk. Otherwise, let's say we don't have a hedge. We don't have a hedge here. Right. Okay, back. Margin there. Let's say we don't have a hedge, right? So yeah, and price goes up, entire 180 is at risk. And if the price goes not in our favor, as long as it does, the risk is increasing. So that means is if we've got 2x, that means if price rises 50% and we've got short 188, that means 100% of the position will be gone. If we keep adding today's average it down and it keeps growing, that means 200. And then again, we are getting in a situation where we lose our deposit. Yeah, I hope that helps. So in order to keep probability of loss under control, in other words, in order to keep risk under control, that's why we hedge, because we never know where the price goes. Like here, look, it can go up and up and up and up, and it's really possible. It's really possible. So in case we don't have hedge here and it goes up, we just lose it, and we will hope the price reverses, but it may not, and it happens with me many times when when I hoped and it didn't go in my way, and I could say it's 90% times like that. So what I'm trying to point here is we are risking now 4, right? And here one already, so it goes up. 4, it's gonna go down. It's a bit twice that, even more. That means $8. So we are if it goes up, we are risking $8. But if it goes up and up and up and up, we level it up. The strategy is to level it up. So we add another 100 here. When it goes somewhere on the top, we'll probably close partially the the red one, and we fully close the green one, and then we level them up again, looking at the situation. But the idea is, again, if price keeps rising, that means the equilibrium as a gravity, it's going to pull it down, and the probability it will go down. The probability it will go down is increasing. So the more price goes up, the more probability of the lowering down the price is increasing. But in order not to lose the capital, we have to control the risk. And here, with this schema, we are controlling the amount of capital we're putting at risk. Of course, in an ideal world, in an ideal scenario, we wouldn't like to risk it at all. We would like to just see a perfect setup and see, oh, RSI is diverging or converging, wherever the volume is high, the probability of price goes on my way is very high. I just enter the position, and 90% of my positions are always good, and so on and so forth. Yeah. Never worked for me. Well, at least maybe my neural network is badly trained, and I don't see those parameters I need to take into consideration. Now, last final point. Don't have to tell it today. I'll probably leave it for later because I've been talking a lot already. Right, so next time the topic is gonna be complexity, I believe. That's a very important one. Because the problem there is you've got one position with controlled risk, with probability P, and it's defined like $5, whatever, as in our case. Or if you've got like 10 positions, each of which is having its own probabilities, and then you can close one to open another, or dollar cost average another, and that's going to raise the complexity, and we see the formulas about those complexities and so on. For now, thank you for your attention, and hope it helps.